Hello, everybody. Welcome to Super Stonk Brothers episode number 8. Today, we're going to be talking about Skillz, which is a mobile esports platform that enables mobile game tournaments between players and distributes prizes every month. Since Steve and I work in the mobile games industry, we have a little bit of additional insight into this company. And in addition, today we are joined by someone who actually knows something about investing, Matthew Kanterman, Equity Research Analyst at Bloomberg Intelligence. Welcome, Matthew.
Thanks for having me, although I don't know who this fourth guest is that's going to know how to, talk about stock analysis. But
you know what you're talking about.
Have you seen any of our other episodes?
Yeah. I have. I've dabbled a little bit, so So I hope I'm not going to blow it over the top and just put you guys to sleep. But this should be an interesting discussion.
We're gonna do some analysis, and we're gonna check into this stonk, right? So we're really happy to have you here. And my role for this show will just be asking stupid questions so you guys can answer. So
getting into the discussion today, we're going to structure it into 4 sections. The first part, we're going to talk about the current business and sources of revenue. Second, the Skillz SPAC and the current valuation. Third, key risks. And fourth, future prospects and competition. So let's go ahead and dive right into it by talking about the current business. And maybe Matthew, do you want to provide a little bit of context in terms of the business?
Yeah, so let's give the optimistic view, the optimistic, detail of it, and then I think we all have some sort of a cynical view, so we can then tear it down. Skillz is a mobile gaming platform. They're trying to create a different way for mobile game developers to monetize. So historically, it was either microtransaction in-app purchases or mobile advertising. They're trying to come up with a third way, which is basically letting people wager on games and play against each other. And that sounds interesting from a high level, right? Because advertising is a tough business, particularly with all the changes going on with IDFA. Microtransactions is really reliant on a small cohort of players for a lot of games. So again, IDFA becomes an issue. So maybe this is a cool new way, and maybe this is, as they say, the future of mobile games. Basically what they do is they have an SDK that mobile game developers can just put into their code, and you guys can probably talk way more about this than I can, but, and then effectively it enables, developers to put their wagering system into their games.
Right. And maybe I could share my screen a little bit and we can dive a little bit deeper into the business itself. First of all, it's wanted to note that one of the investors that I have a lot of respect for, which is ARK and Cathie Wood, they have been pretty aggressive in terms of buying Skillz. The stock overall has been on a decline, but then you can see it at the point at which ARK and Cathie bought, and then that kind of caused a spike in the stock. Now, when I went through the 10K, one of the things that I was able to try and determine is like what is the basis of the business? What actually is it that Skillz does? And the way that I thought about it, and just kind of reading through this, is basically 4 things. First is this tournaments and prize platform, right? And so you kind of go in and they provide this platform that enables you to enter into competitions, tournaments, things like that. And so there's that part. There's the prize pools in that platform. The second is the matchmaking algorithm, right? So in order to have a sort of PvP and sports betting platform, you need some technology to match people together. The third piece is really around fraud. And this is something that we'll talk about later when we talk about risks. But, mobile gaming in general, and, Steve could probably talk about this as well, but even if you are completely server side, there will always be fraud. Always, always, always. And so having technology to combat fraud so that when you're playing against other people and they're not running bots or they're not colluding in some way to be able to gain prizes against the platform or against other real players is I would say, tremendous challenge. So that's the third piece. And the fourth piece is really going to be around user acquisition and marketing. And so to the point that Matthew made earlier, there has been a big shift in terms of how you target players. And so the fourth piece is at risk. And the third piece always, I think, is going to be a challenging issue. And then to be honest with you, the first 2 pieces, as mobile developers, I would say those first 2 pieces are not a technology challenge. So you basically have a business that, in my opinion, is really execution oriented, which means it's about, aside from the technology, it's really getting a lot of developers on board and then marketing the hell out of this platform to get people into the ecosystem and into the games to be able to play against each other. And you can see here that, I kind of highlighted some other parts of their business. But the other thing to note is that when we look at their business, Solitaire Cube, 21 Blitz, and Blackout Bingo accounted for 72% of revenue. So right now you have extremely high concentration in 3 games, 2 of which are made by the same company, this company called Tether.
Not to be confused with the crypto.
Exactly.
Yes, crypto bros, stay away. We're not talking about Bitcoin and whatnot.
Yeah, that was episode 4.
Right, and currently, as it states here, they are in 41 states, and that account for about 90% of the U.S. population. So not only are they able to address 90% of the US market, but 90% of their market is US, 10% international. And so kind of part of their growth thesis is going to be, well, hey, we can expand internationally, but we can also talk about that later as well. Steve, did you have any other thoughts in terms of the business? Or maybe we could talk about kind of shifting next to the valuation and kind of, Skillz as a SPAC.
Yeah, no, I think that's a really good summary of the business from both of you guys. What I would add is, from my perspective, they have like some characteristics of what I would call a vendor, or somebody in my position would call a vendor, in that they provide an SDK with technology services that you can integrate into your game fairly seamlessly. And it does a bunch of stuff for you, right? And the vendor relationship is usually very different than a publisher relationship. And these guys also have attributes of a publisher. And I think that sort of dichotomy is very interesting, right? Publishers are often responsible for marketing the games that they publish, right? And vendors usually aren't. So it's just a very weird set of incentives to try to find developers, bring them in, integrate them into this system, right? And then just pump them full of marketing and extract value from them, right? And then, so that works for the developer for a while, right? But it's not clear to me whether a developer can build a long-term business doing this. And there are a lot of reasons for that I think we'll get into later.
Kind of shifting now to the current valuation and kind of looking at the current stock price, it's down a bit, currently sitting at like a little bit under $18, which is about a little less than 7 billion in market cap. Maybe I can stop sharing here and hand it over to you, Matthew, but talk to us about maybe the SPAC process that Skillz went through. Mm-hmm. And then what are your current thoughts in terms of the valuation?
Yeah.
Sure. So
a pure hit of Bloomberg Terminal here. It's so exciting.
So, a SPAC is effectively an empty shell company. And historically, these were actually used by oil and gas companies. Whenever the oil and gas market, like in the middle of the United States, whenever there was a down cycle and a lot of these assets became highly distressed and, they had to shut off because prices went down in the oil market, these SPACs would come out and buy up distressed oil assets. And that's actually how they became known. And, that's where they were used mostly. And then a few years ago, all of a sudden you saw people realize, hey, we can use this for things other than distressed oil assets. We can use this to actually take companies public, via an acquisition. There were in the early 2010s, there was this whole reverse merger craze, and that caused a lot of issues around accounting and lack of disclosures and whatnot. But it was mostly just the fact that a lot of these companies were foreign companies, mainly China, and didn't have good accounting, backing them, and were making up a lot of numbers. But, it's not too dissimilar to that, where you have an empty shell company that agrees to acquire a company and take it public via an acquisition, which is no different than like a company like Zynga buying a private company like Peak, and then thereby Peak becomes a part of a public company. Just in this case, the acquirer has no real business to begin with. In these deals, the fees actually at the end of the day are not too dissimilar to IPOs, just who pays the fees is slightly different. And at the end of the day, why are SPACs attractive to the founders, to the sponsors of the SPACs? Because they get free stock. If they execute a deal, there's a clauses in a lot of these deals that effectively say if you execute a deal within 12 months or whatever the time frame is, you get this promote, which is basically free stock in the company. And then also, they end up, acquiring warrants and stuff as well. So they get a large stake. And, for them, it's really just a way for them to eke out more value. Someone I listened to on a podcast is basically saying, you're someone who's been an exec in an industry for 30 years, you've advised private equity firms on taking companies private or taking them public, but you've never actually been a part of that. You just got a consultant fee. Well, this is actually a way for you to say, instead of just getting paid a consultant fee by Blackstone, I can actually get equity in this thing. So actually, for a lot of these execs and people that, have industry expertise in one way or another, they're doing what they've already been doing, just with more monetary incentive behind it. And that's why you're seeing a lot of celebrities and people from all different industries getting involved, because I think at the end of the day, a lot of them were already doing this before, consulting for private equity and whatnot. Just now they're doing it with a SPAC and they're getting equity to back it up.
Yeah, I think the thing that I don't like about SPACs is because a lot of the SPAC sponsors actually don't put a lot of capital to work against the companies that they're promoting. So in that case, you got nothing to lose. So why wouldn't you just promote the hell out of it?
Yeah, there's no skin in the game, right?
Exactly.
Yeah.
So
I mean, a great example is Grab, Southeast Asian internet company is going public via SPAC. The SPAC was about $500 million, the Altimeter SPAC, and they're raising a $4.5 billion, I think is the total pipe, which PIPE is a term you'll hear alongside SPACs. A PIPE is a private investment in public equity. So basically, they raise a bunch of private money to invest in this entity to give it more capital. And so the founders only had 500 million. And now granted, Altimeter is actually the biggest investor in this PIPE, but they're raising a lot more money on the side for a bunch of, hedge funds and other institutions to invest in this thing before it actually lists, to give them more capital to buy the target company. And so to that point, a lot of times these founders are going out and seeking out more money to help them get these deals done without putting up actually, in this case, they put up more of their own capital, but not in every case are they putting up more of their own capital to back it up.
So Matthew, are there any differences in disclosure requirements or anything like that when you're pulling one of these moves, or is it basically the same thing?
It's night and day. I mean, with an IPO, you have to file the S1 first. Your statements are fully audited. You've gone through rigorous debates with the SEC, with your auditors, with your internal controls people. You have all these systems in place internally. It's a process that can take a year, maybe more, depending on how complex the company is. And this is all done before you file the S1. In some cases, the SEC will send comments and you'll tweak stuff. But, a lot of this is done before you make it known that you want to go public. It's basically the opposite with a SPAC. With a SPAC, the listed entity is this shell company and they're buying something. And so these companies aren't, in every case, fully audited to the same degree as a public company would be. They don't have an S1 until much later down the road, when eventually they're registering the stock to actually, list under their name, and a lot of other factors. So there's a lot less disclosure. There's also a lot fewer restrictions around the types of forward-looking statements they can make. These insiders, these SPAC investors can talk about it like a company would talk about an M&A deal. It's like, hey, we're going to buy this thing, and in 3 years, we're going to get this much synergies. I mean, a company can say that, but in an IPO, companies are very, very cagey about what they say about forward-looking, statements, for a lot of legal reasons around the disclosures. And there's a huge discrepancy there as well. The upside to a SPAC is, if you believe the numbers, you actually get a lot more granular data in terms of the forward estimates the company wants to provide in terms of how they think about their business growing, profitability. But there's just not a lot of regulation that necessarily holds them to those numbers going forwards.
So is it fair to say that if you wanted to pull some accounting shenanigans, and if you wanted to pump and dump something, that the SPAC would be the way to go versus that's one. Not saying that Skillz is doing that.
So I will say that a lot of SPACs have lockup clauses for these insiders, both the SPAC sponsors as well as the management teams of the companies getting taken public. They can be as short as months, 3 to 6 months, or, in the case of Grab, I think Altimeter is locking up for 3 years on the pipe investment they're making. So that's an important thing to watch if you're looking at buying any SPAC, not just Skillz or any company that's been SPAC'd or a SPAC that is pre-deal. Is, those lockup terms are actually very important, because to your point, if it's only 3 months, like, yes, they can get this deal done, wait 3 months and dump all their stock legally. But if they have a lockup of a year, 2 years, 3 years, these sponsors are in it with you, even though they might be getting free stock, unless this company executes, that stock goes to zero. It's free stock that's now worth zero. It's not worth anything. So, they have an incentive, the longer they're locked up in the company, to make sure that they live up to the estimates they're providing.
Yeah, a little bit more of a earn-out type structure.
Exactly. I will note, I think there's been a general trend that some of the more recent SPACs, like the later crop, you're seeing, I think, a bit more pushback from investors on this. And so I think you're seeing the lockups get extended more so, particularly, and I mentioned Grab, like, I think 3 years is I think probably the longest I've ever seen. I'm by no means a SPAC expert. I'm an equity analyst, but I pay attention to this stuff as best I can. And 3 years is quite a long time to be, to say, I'm going to hold this stock and not sell any of it for 3 years. That's quite a commitment.
Okay. And so what are we seeing here in terms of multiples, or as far as a valuation?
Yes. So this chart is the forward EV to sales ratio. It's a forward 12 months. So actually for every company, it's just 2021. But with your fancy schmancy Bloomberg terminal, if you're a subscriber, you can use the BF12 override. So no matter where you are in the year, you can always get the next 12 months. And so you don't have to worry about calendarizing, companies with different fiscal years. That's my marketing pitch for the Bloomberg terminal.
So what we're looking at here, cold shower.
So what we're looking at is the white line is Skillz, and that's one axis on the right. So you can see Skillz at its high was trading over 40 times forward sales back in February. It's now trading at about 15.5 times forward sales. Zynga, which is the orange yellow line, that's trading at right around 4 times sales right now. And actually, for a while now, Zynga's traded around 4 times forward sales. This was a stock that used to trade like 1 to 2 times back in the lows. So it's seen some nice expansion since then, as that business has done very well. But that's a story for another day. And then Playtika, which is a recent IPO that's also a mobile game peer, trades right around 5.2 times. That's the blue line. So you can pretty much see that Skillz, if you're just saying this is a mobile game company, and you're taking the numbers on the surface, this is based on the consensus numbers, which I can show here. This is the forward consensus for Skillz over the next few years. So this is the average analyst estimates that we've compiled at Bloomberg. You can see that, just based on how these numbers are trending, Skillz is trading at a large premium to Zynga, Playtika. And if we just compare this to the Bloomberg Intelligence Global Video Game Valuation Peer Group, which is the green line is the forward price to sales of this group, you can see that that's also right around 4 times. So roughly in line with Zynga. Obviously, we can say that there's a lot of companies in different jurisdictions like Japan here that trade at lower multiples. And so maybe it's not a valid peer comparison, but I just wanted to include this in the discussion as well. So, it's definitely a case of, can you justify this being more than just a mobile game company to justify a premium valuation that looks more like an internet platform or a back-end services company, something like a Shopify, which trades roughly in this range. That's kind of the valuation comp that you're looking at for Skillz where it is right now.
Yeah, that's exactly what I was going to say. Is it's trading like a platform company, and if you look at the business model, it makes sense, right? They don't have to assume the risk of making a good game, putting it out, marketing it, doing the live ops, stuff like that, one at a time, very laborious. Or maybe you do pull a Zynga and do it through acquisition, still laborious, right? Instead, they come in basically through the back door, right? And they now have 9,000 developers signed up, apparently. And again, we don't necessarily know what quality level those developers may or may not be, right? But it is just kind of spreading through the cracks, right? And every developer that picks this up basically multiplies the network effect for the Skillz platform, because they get the ability to cross promote players across their platform to that new game, right? And it adds value to the people that are already on the Skillz platform. So that's why presumably they're getting this valuation, right?
Yeah, I think your argument that can they scale a lot easier than a typical company? Yes, because if the platform works and right now we're seeing it seemingly work on solitaire and bingo, and all of a sudden it expands beyond solitaire and being into other games, then yeah, you could see massive increase in revenue. Now, whether, I guess right now, the question mark, and I guess we can talk about risks later, but the question right now is whether their model actually works or not. we can talk about that. But to your point though, yes, I mean, do they have the potential to massively scale if the platform proves to work, and if the unit economics can work over time?
Yeah.
Then I would say yes.
And I would say they're super duper special sauce. It's more special than any of the live ops stuff. Seems to be their ability to work around Apple's platform fee, which normally burns 30% of revenue, goes straight into Tim Cook's pocket. And this is basically what he and Tim Sweeney have gotten into over at Epic, right? You guys are probably familiar with that, listeners and viewers. You may have heard that Fortnite is up in arms against Apple, iTunes App Store. Skillz does not seem to need to pay that 30% platform fee. Instead, it's basically a sub 2% number to PayPal or to a credit card company. And if I am a small developer, this immediately becomes a lot more attractive to me, because the pitch they can make is, hey, like we're automatically going to make you more money just by virtue of us not having to pay this platform fee.
Yeah, I mean, I think they're operating right now in a gray area where
very much so.
Apple does not want to have IAP payments from real money gaming in any way. And I can show some stuff around that later. But they also, according to their rules, require that anything that unlocks any new feature or capability has to go through their system. So right now they're kind of operating in this gray zone, but at any moment, Apple could decide, hey, you guys need to pay a 30% fee if they wanted to, but they haven't. And, we can go into that.
So the only caveat I would make is that effectively they're operating a mobile wallet that you then use to wager. And so the question becomes, if they're going to start charging the 30% Apple tax on every single dollar that goes into your wallet, does that mean they have to charge that to every single mobile wallet, not just Skillz? So they have to do that to Venmo and Square Cash App and all those other apps, because, aside from what you use the money for, because you can use like PayPal to then fund your FanDuel account. So it begs the question of, do you then actually have to charge it to every single mobile wallet? I don't know the answer to that.
I don't think so, because basically and maybe I can actually, here, I'll go ahead and share my screen now. So the policy that we're talking about is here, and it's the App Store review guidelines. And there's basically two things that we're talking about. So first, section 3.1.1, in-app purchase. If you want to unlock features or functionality within your app, you must use in-app purchase. So in this case, because you're enabling the ability to wager, according to this guideline, you must do that through IAP, right? Mm-hmm. But in section 5.3.3, apps may not use in-app purchase to purchase credit or currency for use in conjunction with real money gaming of any kind. So really what Apple should be doing, if they're following their policy, Apple should just kick Skillz off their platform.
And that is in fact what Google Play has done. They kicked them off their platform. You cannot play Skillz on Android, which is interesting because usually Android is the more permissive of the two platforms.
Yeah. So if we're going strictly by the Apple guidelines, Skillz should actually not be operating right now. But for whatever reason, they are operating. They're living in this gray area. But to that point, and maybe we could talk about risks now, but one of the key risks is Apple at any moment could say, you're done.
You're done.
You guys
That's
are
it.
off.
That's it.
Or, hey, we're going to charge you the 30% royalty, and they could do nothing about it. And by the way, then that would turn their existing economics, which are pretty terrible, into incredibly terrible.
Yeah, 6 feet under, basically. Yeah. And Apple, when it comes to this stuff, they're judge, jury, and executioner, literally. Right. There's no recourse. There's no warning. It's like they're cool with it, seemingly, until the eye of Sauron falls upon you, and then you're done. That's it.
But back to your point about the economics for the developer, right? I mean, right now, Skillz is paying 80 to 85% of of the revenue, of the gross revenue out to developers, basically. I think it's like, I think 2% roughly is payment fees. So then like 83% goes to developers, which is better than 70% if you're on iOS. But if all of a sudden they get the Apple tax at 30%, they're not, developers are going to be like, no, you owe us 83%, which means that now their take rate is going to be negative 15%, not 15%, because they're going to have to eat the Apple tax themselves.
Exactly.
Or developers just say, okay, fine, we're just going to go back to the old way.
Yeah, there is a way to square this circle, and Roblox does it, right? In that the wallet exists on the cloud, it's on the web, right? So you can fuel your wallet from the web, and then also buy IAP through the mobile app, and that seems to be acceptable. So they could do this sort of laborious or tortuous thing where they direct people to the web to load their wallet and then play through the app, but like that's just not going to work as well, right? It's too much friction. Yeah. And the experience as it is right now, I downloaded one of these apps and tried it, is very frictionless. It gets your credit card info from Apple Pay if you have that set up, or PayPal, and you're in. And you're playing and you're losing money in my case.
All right. So I thought we could talk about risks now. And maybe these are some of the risks that I pulled from just kind of going through their 10K, but wanted to also gauge your reaction to some of these risks that I feel are probably the most relevant to their business. So first, we talked about the Apple risk. Second, this one, if users engage in criminal, inappropriate, or fraudulent activities that seek to exploit our platform and users, it could have an adverse impact on reputation, business, whatever. So this is kind of to the point. It was similar to the second risk, is if we fail to detect fraud or theft. So there is the possibility, a very real possibility, and Steve and I can attest, working like no matter what you do, there will be a hack. It will happen. It's just gonna happen, right? And so it's how great is how big is whatever exploit that happens going to be, and how fast can you recover from that? And so I do think at some point something's going to happen, and maybe it's a small thing that doesn't get noticed, but this is a real risk that if they don't manage this properly, could potentially completely, it's an existential issue depending on how big the fraud becomes.
And it may not even be a hack. Like if their matchmaking software starts malfunctioning and they start putting players of different skill levels, different ages, et cetera, against each other, that alone could damage the brand as they call out in there. And that'll, even if it's just a technology glitch, not even a hack or some sort of nefarious action, that alone could jeopardize them. And if we compare this to like Vegas casinos, because that's kind of, if you look at how much they put into, although the odds are always against you as a player, they go to extreme lengths to ensure that the games are fair and there's no outside influence. And that's kind of something that they're going to have to be very, very cautious of, because, if the matchmaking fails, if dollars don't get deposited, or if there isn't a nefarious action like a hack, that could cripple the platform just by loss of confidence in their ability. And, I think we'll get into kind of some of the bear case and the cash, but, that could basically cause a run on the bank.
Right. The next risk is what we already talked about. Our business model depends upon the continued compatibility between the games featured on our platform and major mobile gaming operating systems. I'd say this really speaks to the iOS risk. Any moment they could get kicked off or charged extra. Next is laws. Our business is subject to a variety of U.S. and foreign laws. I actually think that this is less of a risk, especially now.
Seems like it's becoming more permissive, if anything, right?
Yeah, because the governments are so underwater after COVID that you're gonna see a lot of pressure. Like states in particular, I wouldn't be surprised if any of the holdout states all of a sudden say, "Hey, look, we'll allow this. We just want tax revenue," right? Because everyone's going to be looking for more revenue somehow.
My home state, my former home state of New York, is effectively doing that. And it's not only are they doing it because they want the tax revenue, but because they're seeing the leakage of it to New Jersey, because New Jersey has it, and people are going, hopping on the PATH train across to Jersey City from Manhattan, putting bets on their phone and then going back home,
Right.
so it's,
So it's called the laboratory of democracy, right? Federalism. It's really great. People want that stuff.
The next set of risks I wanted to talk about really has to do with disclosure and in particular, so we noted that, basically based upon the fact that they're a SPAC, they had reduced disclosure requirements. But not only that, there's a note here about how they rely on assumptions and estimates to calculate certain of our key metrics, and real or perceived inaccuracy in such metrics may harm our reputation. And if you go into this, basically they're saying, hey, our metrics could be wrong. But what I'm saying as a game developer and mobile developer is very rarely should your metrics be off.
Well, I'll say that this seems like very textbook language that you see in a lot of filings, just because they're not official GAAP numbers. So that's why they're making that clause. But I think to your point, right, unlike Zynga, Playtika, EA, Activision, they're 1 degree removed from the player, right? The developer is sitting between them and the player in this case. And so the developer can count the number of players at any given time in their game. They're getting aggregated data from these 9,000 developers. And so if any one of these 9,000 developers is getting incorrect data for whatever reason, their end data is going to be wrong. So there could be, estimation and measurement error just because they're 1 degree removed.
I guess the point I'm trying to make is that what they're basically calling out, though, is that their metrics, what they're saying is estimation. And by the way, I can present metrics in very favorable ways. And so what they are, what they are calling, whether it's MAU or paying MAU or ARPU, you can tweak those numbers to make them look a lot more. You can window dress these numbers quite a lot.
The fact that they use paying MAUs versus MAUs, right, to generate payer rate is pretty interesting in and of itself. So having run an analytics department at a mobile games developer, there was something that stood out to me like a sore thumb. They said basically that they don't have access to the amount of time players spend in games that use the Skillz SDK. And then they go on to say, we have very sophisticated machine learning techniques that can locate fraud, which is what you were talking about earlier, Joe, right? If you cannot measure time spent in a game, that means basically you have no access to when events in a game occurred. And yes, there's some implementation risk, which is what you were talking about, Matthew. It's maybe the developer screwed up and implemented the SDK wrong, right? They integrated incorrectly with the game. But this is really, really fundamental stuff, right? This is just broadcasting events from a game to a server. They arrive with a timestamp, right? Every developer and every publisher and every vendor should be able to calculate time in game. And right off of the bat, they're like, we have to estimate this. We don't know.
That'd be a key signal for fraud too, right?
No, it's a key signal for everything. If you're doing machine learning, if you have these algorithms, you need timestamps on these events. It's part of the signal. It's a really important part when people do things, right? How rapidly people do things. There's a lot of information. There's a lot of signal in that. And they're just we don't do that. We don't know. So it's I don't know, man.
Next here, just more about disclosure. As a private company, Skillz was not required to document and test its internal controls over financial reporting, nor was its management required to certify the effectiveness of its internal controls, blah, 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 blah. Basically, I don't know, maybe this is, to your point, Matthew, maybe this is standard language, but I don't know. I am a little
It is, but it's a bigger risk for SPACs. I've seen companies go public through an IPO that also had similar disclosure, their internal controls were not, their auditors said their internal controls were not up to snuff and they were in the process of fixing it. And you just kind of have to take their word that they're going to fix it. And eventually they will say, we fixed it. But I know people who do internal controls testing for companies for Big Four auditors. It's not an easy process. No. It can take years to go through that process to get to a level where the auditors are comfortable with your controls. And this is for companies that have already been working at it to get everything in line for an IPO. Now, if you're a private company that never had to worry about that for all the reasons that private companies don't have to worry about that, and then all of a sudden you're going public in 3 months once the SPAC deal closes, you're even further behind the ball. And so, in the case of like a company that's IPOing, it's like our internal controls were not up to the standard our auditors wanted, so we're working on it. But in the case of a SPAC, it might be the internal controls didn't exist and we have to build it from scratch.
Right.
Yeah, and backfill, right? And by then, it's like the company's already public. Who knows who's invested how much, right? So it's like,
exactly.
Yeah, the horse has left the barn. So
right.
Right. Here, it's just they are party to pending litigation. Who knows what that's about?
Sean.
Do you see this a lot in this type of document?
Actually, yes, you do. You see a lot. I mean, a lot of this is just like legal mumbo jumbo. They're covering themselves, in case they don't include this and then someone sues them. It's like, you had a lawsuit you didn't disclose. No, we disclosed it. It's here. It's in the risk section. You just skimmed over it because you got tired and stopped reading.
Like me.
Yes, exactly.
Right. And now let's get to the biggest risk, which is that they have incurred losses since inception. We may not achieve profitability in the near future, or maybe ever, depending on...
Or maybe ever. Yeah.
Yeah. And so let me kind of show you. So I mentioned in the beginning that these are the three games that make up, 70, 80% of the revenue, which is Solitaire, Cube, which is a solitaire game, 21 Blitz Solitaire, and Blackout Bingo. And as you can see here, there was a tremendous spike. This is the download graph, tremendous spike in downloads between something like November of 19 through February of 2020. Now, the interesting thing to note is that many companies did see a big spike in downloads. And I would say on average, it's probably about 35%, but they saw that in March of 2020, not before. And so this seems to indicate that there was a concerted effort to spike the downloads and the business profile for, I don't know, maybe an IPO that they wanted to do a year later so that they can show much larger growth in numbers. And so,
I mean, it was a new game, right? So that always helps, right? But you guys know, of being in the games industry, and I know this from being in my seat and talking to smart guys like you, downloads and user acquisition is gas pedal, brake pedal, right?
Yeah.
It's like, if you floor the user acquisition marketing spend, you can get a crap ton of downloads. It's just,
to your point, actually, a lot of that is Blackout Bingo. But what I would have expected is a 35% spike from March, but instead we're seeing this decline.
Right.
And I would say that the other thing too is now we're seeing this pretty steep decline here.
Mm-hmm.
Right. And so, is this a growth story? I don't know. It's kind of seeming like this sharp drop seems to indicate maybe it's not a growth story, and that maybe a lot of this was being kind of propped up, and now it's starting to fall because 2020 for many game companies was the biggest year ever in the history of games. And many companies who were never profitable were suddenly profitable. Many companies saw massive increases in downloads, and especially in this casual genre, right? Like Solitaire, you see games like Scopely's Yahtzee with buddies, chess, games like this saw massive spikes. And here we're seeing a decline. That's a little unusual. Yeah, the other interesting, as we noted, so, typically when I look at revenue, I expect to see something, but here, because they are, to your point, Steve, they're bypassing iOS, they're not recording any revenue through iOS. Right?
Empty graph, right?
Empty graph. And
the one other thing I would just mention, because you talked about, can they sustain growth with downloads slowing, is people forget the other side of it is, can you profitably grow, right?
Oh, yes.
And I think that's one of the big bear cases around Skillz right now is you could argue they've acquired the most profitable users they ever will have, because those are the people that were going to use it with the least marketing. Right. And as they spend more and more on marketing and giving away free money, you could argue the profitability of those users, the stickiness of those users will go down, the lifetime value, to use, game management speak. And so, that's the big bear case, is actually, does this business have negative economies of scale? They have to spend more and more to acquire the N+1th user versus the nth user.
Right.
And then the LTV continues to come down and down and down until it's effectively zero or negative. That's kind of one of the huge risks around this type of model.
Yeah. To your point, I wanted to highlight that there was some of the bears out there had been speaking in particular about this notion about round tripping of revenue, and essentially just explain that. And here we see this tweet from this dude, Eagle Eye, who says, Skillz is one of the most compelling short opportunities of our careers. We think their accounting materially overstates true cash revenues. We see at least 80% downside from current revenues. And so what are they talking about? And what they're talking about is that they believe that there's essentially this thing called bonus cash. And essentially what happens is you spend $10 in Skillz, they'll give you an additional $10. And they have
that's what I did. I put in $10. They're like, have another $10 of, imaginary money.
Right. And just going back to what part of their business, they're calling it engagement marketing programs, right? So this basically these incentives that they give to players. And essentially what they're saying is that by giving them bonus cash, so you're giving them additional cash that they can then spend, that they then book as revenue. So a number of companies that have used this kind of approach, this round tripping of revenue, are like Luckin Coffee and ComScore, two notable recent examples that both coincidentally also audited by the same firm that audited Skillz. So, it's a little bit questionable. And so the main point that they're making is they're suggesting that a significant proportion of the GAAP revenue is non-cash, meaning it's this bonus cash that they're basically creating out of thin air, granting to the users, and the users then use that and they're booking it as revenue. Matthew, you talked about price to sales ratio. Right? So,
yep.
Like if you're to have their revenue, that makes crazy numbers.
Their multiple is double. And look, at the end of the day, it's a net out, right? Because I think in general, most companies like to err on the side of conservativeness. So whenever there is some sort of net out, mobile game companies did this until the SEC told them not to, actually, is they used to report everything net. And then the SEC said, no, you should report it gross and then take the Apple tax out as cost of goods sold. Fine. But the SEC told you to do that. Before that, they were being conservative and reporting everything net. In this case, they're opting to report everything gross. So they're counting this incentive cash as revenue, but then it comes out in their costs and their sales and marketing costs. So it does net out at operating profit, EBITDA, net income, free cash flow. It's just, to your point, if you're valuing it on sales, your sales number is inflated by this gross versus net. And if you're comparing this company to other companies that are going to use a net accounting in many cases, not in the case of Zynga, because they're using gross in many cases right now, but if you're comparing it to other companies that are going to be reporting net, that's not an apples to apples comparison. And so that's important to consider when you're looking at a company like this.
This affords a company an opportunity to present things in a much more favorable light. And those numbers can kind of get into the wild, right? And grow from there.
All right, well, so those were a lot of the risks that I just kind of pulled. But what about you guys? Any other risks that we missed or anything else we should be talking about?
I got one for you. The games are no good. So I downloaded one of these games, and as I said, I put in $10. It gave me another $10 of fake money. So you want to talk about inflation, Federal Reserve stuff, right?
Oh,
it's
boy.
Like it's happening in this economy already. And this game is kind of like a horizontal Tetris game, and they build these games as being esports, right? This is very far from what I would consider esports. I think about esports as like something from like Riot Games or Hearthstone for Blizzard, right? Super high production, even on mobile, compelling, fun, addictive, right? This is a horizontal Tetris clone that looks like it was made in 2012. It was not fun. I lost, which is even less fun. And I didn't even lose in a synchronous manner, right? It's not like I was playing against somebody live. I was literally playing against nobody. And then the system found a player later that supposedly matched my skill level, except that this person beat me. And I still don't even know who beat me. So it's irrelevant. Now, the SDK apparently supports asynchronous and synchronous multiplayer. I haven't tried any of the synchronous games, to be fair, but if they're anything like this game that I tried, which was like front and center of the Skillz app, I got referred to it, right? It's like, these games are just, they're crappy, right? And if I ran a game developer that was at all confident in what I was doing as a developer, I believed in my product, I would not necessarily want to be associated with these guys, right? Because everything else on the platform is just like low production values. It's not very good. So I consider that a risk.
Yeah, I would say the other thing too is just to talk the potential bull case as well. There are, if they were able to sign up Riot and Activision and every other major game company out there with competitive games where you could be betting on those games, that would be a compelling case for their company. But then I would say, again, going back to that initial conversation of what do they do, right? And would you trust their system of fraud, of matchmaking versus Riot's internal systems of
absolutely
fraud
not,
right.
From what I've seen.
Yeah, or would you just layer their tournament and prize stuff on top of Riot's game or Activision's game? But then, as I told you, that's not hard technology. And if you're as big as Riot or Activision, you just build your own.
You build your own stuff and you cross promote in your own thing. Exactly.
Right.
And furthermore, does either Riot or Activision want to be associated with Skillz when Skillz gets kicked off the App Store? Right? Like, does that take down their games along with Skillz?
I mean, we even heard Andrew Wilson, the CEO of Electronic Arts, talking about they could potentially see betting as a future revenue growth opportunity because they're so aligned with sports. But to your point, why would EA, this ginormous publishing organization, not build this themselves?
Right.
You know, they already have so much of the matchmaking done. They just have to figure out the betting, which is, you know, technology they could license from like a company like Camby or something. And then voila, they have their own solution. And so, you know, I think the addressable market for this is, you know, as we kind of talked about, smaller developers that are trying to find their way, that aren't sure if they can profitably scale a game in the old way and monetize in the old ways. I think that's the addressable market. And like, if you look at kind of like the revenue forecasts, and this is going to kind of tie into what you're talking about, the types of games, is, you know, a lot rests on their ability to, as they talk, you know, in their filings, they've said they want to expand into non-casual games. They want to get into shooters and this and that and this and that. But how successful is that going to be? Because I mean, the closest thing we've ever had in a shooter game is like skin betting in CSGO, and that got shut down real fast. So, you know, I'm curious, like, as game developers, how you guys think about the applicability of this type of business model, revenue generating model to a shooter game. Joe, you have experience there actually, now.
I think that it exists. Well, it did exist in PUBG Mobile in India because I think it was legal. So I'm not sure how much that was happening, but it was happening. But then again, that just speaks to whether other companies can just do it on their own. And I just, speaking to the growth prospects, I guess I think we kind of agree that the market really lies in smaller developers that are looking for additional sources of revenue. I think that if you are a company like, whether it's a Tether or the other company that had made a game and you wanted to get promoted like crazy, working with Skillz is great. They're spending, 100% of their revenue on sales and marketing. So
especially as like the companies you used to go to help scale your game, like AppLovin, are now your competitors. And so you increasingly have fewer options to help publish and scale your games. And so more and more could see a platform like Skillz or some other as kind of like a neutral Switzerland, as more and more of these other platforms, even Iron Source is talking about getting into first party content now as part of their SPAC deal. So as there's fewer and fewer neutral, Switzerland type platforms, that's attractive to smaller companies because they don't want to be left behind.
Yeah. So I would say that the things that bother me is that you probably should take a closer look, but it certainly seems like they've got negative unitary economics, that they have a limited market potential, and the whole accounting thing, it does not make me feel comfortable with their business. So I don't know. I don't see personally the current market valuation at near 7 billion as as reasonable. I think it's going to come down.
Cathie Wood invested big into Skillz. ARK invested big, and you follow Cathie Wood, and so do I.
May I share my screen real quick and show this? Yeah, let me show some more fancy Bloomberg terminal.
Awesome
terminal magic. So here we can see the top shareholders in Skillz, and this is the common share. So I'll just show this real quick. So there are two classes of shares. There's the super voting shares, which are mostly controlled by the founder, and then there's the common shares that trade that we all see in the market, and that's the A shares. And so, looking at the owners of the A shares, we can see that ARK is a top 10 holder now, with the shares held in the ARK Next Gen Internet ETF and the Innovation ETF, which is the one that most people know. That's the ARKK one. So, so Cathie Wood is a big holder. They own about 3.5% of the A shares outstanding. It's closing in on 12 million shares now.
Morgan Stanley and Vanguard also own quite a bit. Perhaps
and those funds? Those are the usual suspects because of index funds. You can dig into where these things hold. I won't go all the way down the rabbit hole, but if you pull up a company, if we pull up Zynga just to compare it, right? The usual suspects will show up: Vanguard, T. Rowe Price, BlackRock. These are a lot of mutual funds, ETFs. Yeah. Some is active. Things.
Mark
some of this will be active. Yeah. Well, yes, we all know Mark owns a lot of shares, but those are the usual suspects you see, and you're not surprised when they show up. But ARK is a purely active shop. They're not indexing to anything. They're buying what they think has value, and so that's why that's something to point out.
Yeah, it seems like ARK tends to invest based upon long-term themes rather than digging into understanding the businesses very, very minutely, at least in the Skillz case. I think they did a good job on Tesla.
And I think they did a good job on Bitcoin. So,
I'm not gonna, they've done extremely well. So we're not, it's not right to sit here and bash them. But I think it's fair to say, look, there's a lot of people, and I've said it in general terms, a lot of people applying VC type math to public equities right now, to public growth equities, in the sense that they're saying, okay, this market is going to be so big in 10 years. If this company claims X% of that market, they're going to be this big. And I think at scale, they can be this profitable. And so I can make an ROI of X, Y, or Z over this decade based on, or an IRR over this decade based on, what I think this is worth in 10 years, discounted back to today. There's a lot of that going on to justify a lot of these high-flying tech stocks right now. Whereas it almost seems like a lot of the value math is now going to VC land. I think VCs are being a lot more cautious on valuation than they've been in the past. And a lot more of those types of valuation metrics that we saw historically in VC growth is actually now being done in public equities. And I don't know. It's too early to say if this is going to work or if this is just all going to blow up in everyone's face, because it's going to take a decade to see if it works. We're just going to have to wait and see.
Might be sooner for Skillz.
Somebody else is going to have to wait and see.
It's pretty sharp on the download. But
yeah, they got to find new superstars. They need to find new.
Yeah, but by the way, having like 3 games that account for such a huge part of your revenue composition is good and bad. That means another 3 games could double their revenue.
That is very true.
I believe the CEO was saying on a recent conference call that the new game, the one from the one developer, not the Tether, the other one, could be on path to become. That one could be on path to become the largest game, like based on the trends they're seeing. So like it's clearly moving pieces. But they're going to have to go out and sign these companies up, and it's they have to find they have to find partner studios to work with them, and then spend a lot of money to scale these games. And I think going back to what I was saying before, they did give some numbers in the fourth quarter. They actually saw a big drop in their LTV to CAC. They disclosed it was like 3.8 times at the end of 4Q versus 4.5 times at the end of 3Q. You guys know way more about what these numbers mean than I do, but that's not good. Now they're writing it off to some short-term things and blah, blah, blah. But if that's a trend that holds and the LTV to CAC continues to narrow, eventually you reach a point where you're not generating an economic profit to acquire new users. And that goes back to the question of, does this business have negative economies of scale?
Right. And going back to like, what is the fundamental basis of this company? One of the things we mentioned is marketing. They seem to be doing a good job, but to the point that Steve made earlier, we do have this notion of IDFA deprecation, meaning you can no longer specifically target users based upon the user data.
Yeah.
So therefore, it means that will they be able to get the kind of marketing return on users that they had when you had highly targeted advertising channels like Facebook and Google, value optimization, app event optimization, things like that. In the new world, post IDFA deprecation, who knows?
Yeah. If your unit economics already suck, like this is going to do you no favors and might actually kill you, right? Because it's just going to make everything harder. And that's a secular trend. It's across the industry. It's not just Skillz. It's everybody. It's our business. It's tough. It's something we have to deal with. But like, we're established. We have pretty good unit economics, so we can like figure it out, right?
And this and you guys, Eric Seifert, who's now joining Twig full time, but he's kind of like an expert on all of this stuff.
Yeah.
He's written about, the rise of the content fortresses. And at the end of the day, I think, and he said this, and I agree, like one of the big outcomes of IDFA is it actually is just going to, kind of insulate the large players in the mobile market potentially and make it harder for smaller players to compete and, become large players. It's going to it can have the effect of oligopolizing the market. And from that perspective, a company like Skillz that is in the minority is not one of these large content fortresses, could be at risk.
Yeah, they have 3 games that are at pretty minor scale. So
yeah, they could be at risk. It could impact their ability to cross promote as well, because they're not going to be able to use the workaround that publishers use. So maybe they pivot and become a publisher. It wouldn't surprise me to see them actually start developing their own games.
Yeah, that's true. Like if they became a publisher, then you could use IDFV to
exactly. The workaround, so you can move players around inside your network.
Right.
And to the earlier point, it's like they have to go out and find good games. Maybe they're not able to. They have to develop them themselves, right? And that's another form of execution risk. And then they're just like a more fragmented Zynga, right? And that's not a very compelling story to me.
And not only are they more fragmented, but they don't have the games industry. We can talk about scale, but really your economies of scale is within a studio, within a game, right? It's not just like, I talk about this with investors about AAA companies when you compare like Ubisoft to EA or Activision. Like, why are Ubisoft's margins so much lower? They're a huge company. They have 10,000 plus employees. Well, they only have one game that sells 10 million units consistently. Yes, I mean, their investor pitch a few years ago was like, yeah, well, if more of our games sold 10 million units every year, we'd be more profitable. Well, of course you would. I mean, yes. And the same holds for mobile, right? I mean, if you have several games earning $100 million or more, whatever your threshold is for large, that become for Zynga forever franchise or whatever the equivalent term is for other companies, you're in a much better position than when you have, 1, 2, 3 kind of big games and then a really, really long tail, because that long tail is probably all losing money.
Yeah.
All right, guys. So
you gonna invest? Who's investing?
I am not allowed to invest in anything within my coverage universe, so that's a no. Yes, but that's not saying I would not buy, or it's not saying I would sell. I do not have a position, and I'm not allowed to.
Okay, Steve, what about you?
Yeah, I'm either neutral or short on Skillz, and I haven't decided which yet. This might I've never done any options trading, but this could be a place to start, in my opinion.
I do think it is, for me, I think it is a good short opportunity. I just think they're way overvalued for what they have and what they've proven out. And that the accounting to me is sketchy.
There's just a lot of risks. There's existential risks, starting with like
a number of them.
Starting with the App Store,
Apple,
just being like
IDFA.
I mean, if you look at some of the most successful investment funds of all time, what many of them excel at more than others is being able to price risk. And there is a value in every investment for the amount of risk you're taking. It's just, can you accurately price those risks? And then, people will say, this is a good business, I should buy it. And this is a bad business, I shouldn't. Well, based on the price of the risk, a good business could be overvalued and a bad business could be quote unquote cheap. It could be value.
Right.
It's how you frame, your relevant ability to price risk. This is something like Bridgewater, Ray Dalio, this is something that they've excelled at, is the ability to price risk across asset classes and basically move between asset classes. And so, I'm never going to sit here and say something is, a great business. There's people that say this is a good business, you have to buy it no matter what. And I don't necessarily agree with that mentality. Maybe I'm more of I have a boomer value stock investor mentality, but that's just kind of how I view things. There is a price at which everything has value. It's just, being able to effectively price that risk.
Yeah. And to that point, Matthew, I mean, we can return to where we started on Skillz, and we basically opened by saying these guys are priced like a platform that is executing well, right? or has already executed, depending on how you think about it. And it's like, well, they're a platform. It's remains to be seen how well they're actually executing, and it remains to be seen if they can stay alive in like a pretty fraught environment.
I mean, they're overvalued. The economics currently suck. I mean, not to say that they can't eventually scale, but the economics today are terrible. And 3, they've got a number of existential risks hanging over their head. So, I mean, for me, it's a short, massive short, about the biggest short I know. I'm aware of.
just like Eagle Eye Research said, it's like the biggest short of our careers, right? Or whatever.
The other thing to remember, and I'll leave it. This might be my last comment. I'll quote Tracy Alloway, who's in Bloomberg News here in Hong Kong. She said this about GameStop, and it's relevant. Flows before hose. Flows matter. And to your point, if ARK and others and other active funds are buying the stock, in the near term, flows can affect performance, and that's also something to consider if you're, considering a position in any security, not just Skillz.
Yeah. Yeah, it's I think Warren Buffett said it's stocks are a voting machine before it becomes a weighing machine or something like that. But yeah. Anyway, yeah.
That's good.
All right. Well, I think that's it, guys. Thanks so much, Matthew, for joining us.
Yeah, thank you.
It's great to actually have like a real pro on with us.
Yeah.
Because we're just, idiots. Well, I am, not Steve, but
no, very much so. We're both silly, but that was amazing. And I loved seeing the terminal. That's awesome.
Cool. Yeah. All right, guys. Thanks a lot. And that's it for SSB number 8. Till next time. Catch y'all later. Bye.